All right. Welcome, everyone. My name is Andrew Stotz, and I'm going to be talking about the all-weather strategies, the performance of these strategies, but also what the heck is going on in this world of investing. It's such a difficult time to manage your money. When I look at, for instance, when I look at the U.S. and the Fed increasing interest rates so aggressively, when is that going to hit the market? Is it going to hit the market more than it already did? Or are we going to have a soft landing? What about inflation and commodities? What about bonds? There's so many things. I would say this is one of the most difficult times I've seen in my career for managing money. Now, before I get started, somebody asked me about my monkey. And I wanted to introduce you to Curious George. Curious George is 57 years old. How do I know he's 57 years old? Because my mom gave me Curious George when I was a baby, and I've kept him with me all of these years. Now, I want to mention that if you have any question about investing, business, life, anything, you can put it in the chat, and I'm going to answer every single question that you put in the chat tonight. So feel free to ask any question, and I'll do my best. All right, let's get started. We're going to go into the PowerPoint presentation, and we're going to walk you through the review for December and try to understand where things are at and where they're going. Remember, you can ask me any questions in the chat, and I'll answer them at the end of the presentation. Feel free to ask me any questions or just say hi. It's good to see you guys. So we're going to talk about how only gold was up in December. We're going to have a performance review of our strategies. So what were our strategies? Well, all-weather inflation guard fell by 1.1%, and all-weather strategy fell by 0.7%, and all-weather alpha focus fell by 2.2%. It kind of makes sense that the all-weather alpha focus fell by 2.2 because that's our highest risk strategy right there. And so when markets are down, it's going to be more volatile. And then we're going to look at the global outlook that guides our asset allocation. Now, I haven't seen any comments, and if you have any comments or questions, or you just want to say hi, can you just put in a comment in the chat just to make sure that the comments are working? So make sure you put in a comment, say hi. All right. Yep. Ashiat, good to see you. Okay. Comments are working. Feel free to put in any questions that you may have. Good to see you. Okay. I see the comments coming through. Tanawan, good to see you. Hello. May, good to see you. Also, Patarada, good to see you. Welcome, everybody. I see some are coming in from Facebook. Some are coming in from YouTube. He says, hi, Andrew, just come to pay attention for your talking about investment. I appreciate that. All right. Wow. We've got a lot of friends on. Panda. That's good. We Lie, good to see you. Wujisak, nice to see you. Precha, very nice to see all of you guys. Keep those questions coming. Feel free to ask as we go through. Let's go back into the presentation. And I'm going to talk about then finally the global outlook that guides our asset allocation. So let's look at December. Here we can see that world stocks were down in 2022 by 18%. You can see I'm highlighting the world stock line. That is the red line. Let me just grab my pen just to make sure. It's the line that has a shadow around it right there. And basically, recession fears and uncertainty about the consequences of Chinese COVID outbreak pushes stocks down in December of 2022. We can see that fall right there in that final month of December. So the Thai money market stayed flat. We can see the line right there. Now, we talk a lot about world bonds, but the fact is we're mainly holding Thai money market bonds rather than global bonds. We have target allocations to Thai money market in all-weather strategy and in the all-weather alpha focus, which was flat as expected. And keep your questions coming. I see Balconf says, what is your forecast for gold this year? Also, we see another one this year. What do you focus on investing? We'll talk about those as we go through. The main purpose of our money market allocation is the protection of downside. Now, commodities outperformed most equity in December of 2022, but lost 1.9%. So you can see that equities fell pretty steeply in December. Commodities in this case fell, but not by as much. In fact, what we can see here is gold was the best performer, and we can see that in December, gold was actually up by 2.5%. Gold closed the month at $1,823 per ounce, a very respectable item. Now, what's interesting about this chart is if you look at the gold price over time, it's been kind of flat. And if we look at world stocks, we can see they fell, they rose, they fell, they rose, they fell. But gold is kind of uncorrelated with world stocks. And that's why we use gold as one of the ways to protect the downside of the portfolio. The increased uncertainty regarding China and a weaker US dollar were the main drivers. Remember, dollar down, gold up. Dollar up, gold down. That's the general rule. So let's look at our all-weather inflation guard, which fell by 1.1%. This is our lowest risk strategy. 30% of the strategy was allocated to equity and 60% to bonds, and then another 5% to commodities and gold each. We're making no changes tonight, so we're really here to talk about performance and talk about what we see going forward. Now, we launched this strategy in July of 2022, so it's not a huge amount of time, about 6 months. And we can see here that it was slightly below the 40-60 strategy since inception. But generally, we can see it was down 0.2% and has underperformed 40-60 by about 0.3% as of January of 2023. A tiny bit of underperformance, but remember also that's after fees. And if you look at the volatility, we can see the strategy has experienced a lot less of that downside volatility that we can see in the 40-60 strategy. So that's the performance. And for December, the strategy was 0.9% above the 40-60 portfolio, which we can see was down 2%. Though the strategy fell by 1.1% in December as equity dropped. All right, so now let's look at the all-weather strategy, which fell by 0.7%. But before we do that, make sure that you're asking your questions. I'm happy to answer them. I see a bunch of questions about China there. That's good. What do you think? I like this one from Balconf, which says, for long-term investments of up to 20 years, you think gold is still a good idea to diversify risks? PPSS Sachs says gold is up high level now. What can make gold price down and up from the point onwards? It sounds like you guys are interested in gold. You're interested in China. Those are two things that I'll definitely talk about as we go through the presentation. Let's continue on with the all-weather strategy. And we have 25% allocated in each asset class, 25% in equity, 25% in bonds, 25% in commodities, and 25% in gold. We're making no changes again tonight. Now, I'm really happy about the performance here. It's above the 40-60 strategy since inception. The strategy was 7.3% above a 60-40 portfolio as of the 6th of January. And I just want to look at this line for a moment. This is kind of the exact thing we're trying to do, is when the market crashes a bit, we're flat. That would be a dream. And that's what we're trying to continue to get to with all of our strategies. Here we can see that in December, the strategy was 2.3% above the 60-40 strategy. Even though ours was down right here at 0.7, it still was better than a standard kind of 64 portfolio. Let's review our 25% allocations. Gold, well, we were 25% in gold, and it was the best performer. Bonds were kind of flat. So, in equity fell. We can see, in fact, commodities were down a bit, but most importantly, we had only a 5% weighting in the US at that time. A 5% weighting is a very low, that is the lowest weighting we will ever have in the US. And it paid off in this particular period that we were basically almost no share or no investment in the US. All right, let's look at all-weather alpha focus, which fell by 2.2%. Here we can see was equity is about 73% of this strategy. This is a more aggressive strategy. Gold is at 25%. We're making no changes to the allocations, but let's look at performance. Here we can see the all-weather alpha focus. Well, it's below the 60-40 portfolio since inception. Of course, as I said, this is after fees. And the strategy was 0.7% below the 60-40 as of the 6th of January. So I'm not happy that it's gone from 100 down to 88.9. But, we know that the market's gone down. In fact, let's now bring world equity onto this chart. If all you did was just buy world equity, you would have been down more and you would have had a more volatile ride. So from that perspective, the alpha focus strategy is trying to give you as aggressive allocations as we can give you to the equity market, but trying to reduce some of the risk. And so we've done that so far. Since inception, the strategy was 6.5% above the world equity, which as of 6th of January 2023. Now, don't get confused. The 60-40 is the one that we've been saying is our benchmark, and we didn't beat that. But what I can say is that we provided a good equity exposure without as much equity downside. I never mind, one of the lessons I've learned, and maybe I'll just talk to you briefly about this, but one of the lessons I've learned in investing, and I think it's one of the strategies that we do, is that we have a structure, and that structure is called FVMR, and we follow that for our selection of the different assets that we're putting in the portfolio. But we also have another structure, which is the timing with which we do our allocations. And basically, we put our allocations into the investments that we like, and we hold them there for 3 months, and then we reevaluate them. We may not change them, but we're definitely going to start from zero and reevaluate them. That discipline of focusing on rebalancing and re-looking at the portfolio every quarter, it really allows us to just let the market go. And that means that sometimes the market's we're going to underperform. Sometimes we're going to outperform. But I also know that this is a long-term strategy. I'm still young. There's many years ahead that we can be investing in these strategies, maintain them, and let them grow over time. So on the days that we feel down because we underperform, we know there's going to be plenty of days that we're going to outperform. So my main point that I want to get across is think long-term and stay with us with this as we just continue to guide ourselves through so many ups and downs. All right, back to the PowerPoint, just to go through a couple of other points. I think, in fact, I'm going to sit down, and I have one of those electric desks, so it's going to go down, and I'm just going to sit down and relax because I know pretty soon I'm going to get to your questions, and I see a lot of good questions. Nan says, what on your shelf behind what's the name of the monkey? The monkey's name is Curious George. Curious George was a famous toy when I was a kid, and my mother bought that for me when I was a baby, and I didn't pay attention to Curious George when I got older. And for some reason, when my father passed away, I went to clean out the house. And what I found was my mom had kept Curious George for me for some reason for 57 years, And so when I brought my mom to Thailand to live with me when my father passed away, I also brought Curious George. And in fact, last year, my mom gave me a gift of a little Curious George book, Curious George Learns Math. And so that is what's behind me on the book. All right. So let's continue on. I see you guys got good questions. I see an article, a message about Howard Marks. I sent an email to Howard Marks to ask him to be on my Worst Investment Ever podcast that I do. And he was kind enough to reply and said, I'm just too busy, but I appreciate that you invited me. What a gentleman. What a gentleman. Anyways, so the Alpha Focus strategy in December was 0.6% above the 60-40. And we can also see that the strategy was 2.8% above world equity. Again, when markets are down, we're aiming to outperform. Our 22% tilt to commodities, together with small allocations to gold, bonds, and world healthcare, led to the outperformance. Now, I have here a comparison of all-weather strategy, which is red, the inflation guard strategy, which is green, and you can see it's very flat. That's our objective with inflation guard. And then the all-weather Alpha Focus, which is more volatile. That's the blue line. And really, they're all kind of coming into the same point. And part of what that tells you is that even in our aggressive strategy like Alpha Focus, we still have protection on the downside. So we started AWIG in July of 2022. So the period of comparison is short over this time. AWAF has had the highest return and volatility, and inflation guard has had the lowest volatility and the end return slightly better than AWS. Of course, using short-term performance is not really a great way of looking at it, but it gives you some idea. Now, again, this is going back, this chart, I'm going to go back to that chart just for 1 second. And what we're going to see is that this chart, as I said, is only starting from July of 2022. And that's because that's when we started inflation guard. So we're just looking at a short period of time for these strategies just because we wanted to compare them. Now, if we brought the equity, world equity, which is the dotted line, into here, we can see so much more volatility. This is what we are trying to do for you so that you don't freak out when the markets fall. We are trying to manage risk and reduce the downside in the portfolios. And you can see that we did it there and we did it here. It doesn't guarantee we're going to be able to do it in the future, but the combination of stocks and bonds and commodities helps us to do that. So this gives you a picture. As of the 6th of January, AWS was 1% above and AWIG and AWAF were 2% above world equity. And that's really describes a lot of what we're going to do. Now, I'm going to talk a little bit about global outlook that guides our asset allocation. And then I'm going to get to your questions, which look exciting. So let's talk about equity. Inflation has been through the roof, but the US 10-year bond rate has been cooling off, and higher prices at some point reduces demand, and a higher base is also likely to reduce the inflation rate. So inflation probably has peaked. It definitely has peaked in the US. This is world inflation that I calculate. Now, here we can see in the US that CPI appears to be peaking at this point. If there's no significant oil price moves from here, it could be a peak for US CPI. But of course, the feed through of high oil prices could keep food and everything else in the US, high. It's going to prevent CPI from collapsing. A couple of months ago, we experimented with a show called Your Wealth Engine, and we did it for 4 weeks to kind of get a feel for it and then to think about if we want to continue that. At that point, I spent about 40 minutes going into US CPI, and my conclusion at that point was that US CPI is coming down. It's not going to come down fast because the high energy prices is going to feed through to many other parts of the economy, but generally we can see that. Now, this is an interesting one. The red line here is M2 money supply growth. So we call that money supply. The collapse in money supply growth signals the return to normal inflation in the US. Well, look at this. This is incredible. This is the growth in the money supply, which at its peak was about 25% increase in the total money outstanding in the US. And what happens when you do that? Eventually you get inflation. And here we can see that a rise in the money supply led to a rise in inflation. So what's going to happen with a collapse in the money supply? I think we're going to see a collapse in the inflation rate. Now, is inflation going to go negative? I don't know. It's possible, but I would say it's more likely that it's just going to go low. I would say maybe 3%. Remember, this chart is all the way up to 30%, but 3% would be about right here And I would say that 3% would be just fine. Also, my favorite economist, Milton Friedman, said inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by more rapid increase in the quantity of money than in output. Now, I'd like to talk to you about inflation for just a moment because I think it's critical. People misunderstand about inflation. And when oil prices rise and the cost of oil is in many things like the cost of transportation and things like that, we see that many other prices rise. So is this inflation? Well, most people would think that's inflation, but it's not. It is a relative rise in price of oil and of the other components that it's feeding into. It is not inflation. Now, when I say it's a relative rise in price, why is this an important thing to understand? Because of this. If you are buying a lot of gasoline or petrol for your car every month, and let's just say that it doubles the amount, the price of gas or petrol in your car doubles in 1 month. That means that you have a certain amount of disposable income. Now you have to take some of that, more of that, and use it to top up the cost of your energy. And that means that you have less money to spend on other items. When you have less money to spend on other items, that decreases the demand for those other items. And therefore, when demand falls for those other items, what happens to the price? The price of those other items fall. So that's why we would call that rise in oil price as a relative price increase. And when something rises a lot, it takes money away that was going to be spent on something else, which is going to cause that other thing to see its price fall. And this is not inflation. What is inflation? The way to think of inflation is inflating like a balloon the money supply. The more money you print, the more money you print, the more money you print, the less it's worth. And that means that it buys less across the whole economy. That is inflation. CPI and individual prices and cost pushing, what we call cost push inflation, is not technically inflation. It is a relative rise in price. If you have any questions about that, let me know. But that is something I feel like is an important thing. Now let's go back to the presentation, and I'm going to go through a few other things. Now here we can see in this, see if I can get the presentation up. There we go. And I think I'll just show it full screen. So the market expects inflation to return to normal. This is pretty amazing. This chart is what we call the 10-year break-even inflation rate. So if you think about a bond as an example, let's say that you're going to earn 5% on a bond. And there's going to be two components to that. There's going to be one component, let's just say that that's 3%, that's inflation. And then there's going to be another component, 2%, which we would call the real interest rate. And the combination of these two is 5%. And what you can see is that over a 10-year period, expectations are coming right back down to normal. And if they come back down to 2 for expectation for inflation over 10 years, and let's just say this stays the same, then the overall inflation rate or the overall return is going to come down to 4%. So this is interesting. The 10-year break-even inflation in the U.S. is at 2.3%. So the market expects the Fed is going to get control over inflation. This is a 10-year. So in other words, if you're buying a 10-year bond, the return you're getting, 2.1% of that return is to cover inflation that the market expects is going to be 2.1%. If inflation expectations are too low, equity, commodities, and gold could get a boost. So now, history tells us that inflation can be very persistent. This is a long-term chart going all the way back to 1899. That was when my great-grandfather was born. And once the 2% mark on inflation is breached, it's taken a decade or more to come back down to 2%. If history is any indicator of future, we could expect greater than 2% inflation for years to come in the US. And I would say that's probably pretty reasonable. Maybe it's going to be 3%. It could be 4%. but I doubt it's going to remain at a very high level for long. Now, after a 4.7% rate hike, the market expects, by the Fed, the market expects the target rate to peak at 5% in June, in the middle of the year. Everything is really, market expectations is that we're going to see a peak in rates in the middle of the year, and that we're going to see the economy starting to have a recession in the middle of the year. Currently, market participants are betting on a peak rate between March and September, so let's just say June. And considering the weighted probabilities, the peak rate is expected in June. So now let's look at the yield curve inversion, and it's diving deeper. This is the 10-year Treasury minus the 2-year U.S. Treasury. Now, I think that this, the original work done by Campbell Harvey, is basically, I think, using the 3-month and the 10-year, but we've used the 2-month here. So we still need to look also at the 3-month, which Alex, I think, is on. We have to look at that, and we'll go through that. But if we look at the 10-year return minus the 2-year return, all recessions in the U.S. since 1970 were preceded by an inverted yield curve. And what we can see is that the inversion means it's below that horizontal line, and it is, and it has been. The average time from inversion until recession started was about 1 year. Supercorn, nice to see you. Good to see you. And I'm going to talk about this for a moment. Some people, it's a debate, and in the Valuation Masterclass Bootcamp, and with my apprentices that we have in our company, we're having a little work, or we're doing a little work on this, and I'm going to talk more about this later. But the point is that many people are saying that the jobs market is really good in America, and therefore, how can there be a recession? The economy is not bad. And basically, what I would say is that look at this yield curve. It tells us that a recession doesn't even start until 12 months. We're still 5 or 6 months away from when a recession would start. And so I think that if we're going to have a recession, which I think we're going to probably have, if we are going to have a recession, then that recession is not going to be until 6 months from now. So that gives you a reason why it's possible that we don't have inflation. Let's say we don't have signs of a recession yet, but I think it's coming. All right, let's look at valuation. Valuations have come down primarily due to price falls. We can see the peak of this red line was about 20 times PE, right? What we're looking at here is the forward PE ratio and the forward net profit, which is on this side. So we can see net profit peaked at 11%. That's what this is. And PE peaked at 20 times. What's happened to PE? It's gone down right here, just above the, just near the average, let's say to about from 20 down to 15 times. And we can see that the net margin's only gone from 11 to 10.5 times. And this is part of the reason why some people who are optimists will say, yeah, look at how strong profitability is. Profitability is so strong. But other people would say, look at how high profitability is. That profitability is going to fall over time, and it's going to come back to the average, which is going to bring it from 10.5 down to, let's say, 8%. And if that happens, we're going to see that the PE ratio isn't as cheap as it appears, because as earnings fall and analysts adjust down their forecast, we're going to see that earnings will be falling, PE will be rising. So the world stocks valuation is now slightly below its long-term average. So from a world perspective, not a bad idea to add equities at this point. While the consensus net margin has come down a bit, there has been no significant downward revision. Now, here we can see, let's look at QT. Quantitative tightening means that the central bank is lowering the assets on its balance sheet, and a real strong QT would see the balance sheet of the banks falling like that. But I think that we probably have maybe a little bit longer, and then eventually we're going to go back to QE again. Remember that I think that the Fed and the central bankers are going to break something, and when they do, they're going to see markets and the economy collapsing, and what they're going to have to do is do QE again. Look at the increase in QE. Remember, we've rebased this to 100, and QE went from 100 to about 170. So it went up about, central bank assets went up by about 70%. And that would mean that if we were at, let's say, about 200 right now, that would mean that it would be going up by a lot more than that. Let's say it would be going up all the way up to about right there. So mainly central banks have let bonds mature, which has led to little change in their balance sheet. So all they're doing is, instead of rolling over money that they're lending the US government, they're letting that mature. The Bank of Japan's balance sheet began to grow slightly in October of 2022. Now here we see the Fed started tapering in an attempt to avoid stagflation. But I would argue when the Fed tries to taper, it has to increase. When it tries to taper, it has to increase. When it tries to taper, it has to increase. And when it tries to taper, it has to increase. That's my argument right there. While the balance sheet is still massive, the lack of new liquidity has led to price falls in financial markets. Expect the balance sheet to reach new heights when the Fed again needs to step in as the buyer of last resort. Now, for the past year, we've said that we think the course of the central banks will eventually be reversed. We still think central bankers and politicians will change course and return to accommodative policies as soon as something breaks. And we do think that the central banks are going to break something. You can't increase the price of money so fast without some impact. Central banks may kill growth, but not inflation, and we'll get stagflation. Stagflation is typically bad for both stocks and bonds. Commodities have typically done well during inflationary times and have been resilient during stagflation. Gold has historically fared well during stagflation, and we see opportunities to allocate to specific sectors and markets within equity, like energy and India. Let's look at bonds. Bonds are typically a safe place to be, even though 2022 was exceptionally bad. In recessions, safer assets like government bonds are typically going to perform well. And though with high inflation, low yields could still lead to negative and real returns. We typically don't allocate to bonds to speculate on the upside, but rather use bonds as a way to protect capital over time. Now, before we continue on, I just wanted to say, my goodness, 220 people I see on the call right now and on this meeting. I want to welcome everybody on here. I want to encourage you to ask any questions that you have. I'm going to do my best to answer every question. But most importantly, I want to thank you for taking time, whether you're sitting at your office and you still have more work to do, whether you're driving home and you're watching it in a safe way in your car, or whether you're at home relaxing and watching it. No matter where you are, I appreciate that you tuned into this to learn more and to share our thoughts. So feel free to ask any questions as I go through. Let's talk about commodities now. And I'm going to show you some of my thoughts on commodities. Basically, European natural gas prices remain volatile. This is crazy. Shooting up, shooting down, shooting up, shooting down. There's a lot of volatility relative to oil price. Europe's Russian gas dependence influences prices. And if the weather gets colder, gas shortages can quickly deplete and prices will rise again. Now, there's fundamental support for energy prices. OPEC Plus keeps missing its output targets, and the cartel is announced to cut production and support oil prices. Ukraine war could lead to further supply shocks, and energy prices can also remain high due to past underinvestment in new projects. Food prices have softened, but supply for agricultural commodities could tighten again. Supply for agricultural commodities could tighten further due to volatile natural gas prices or export bans. And La Nina could reduce the supply of essential commodities like corn, soybean, and wheat. Now, commodities have fundamental support. Demand for necessities like food and energy, inflation, and supply chain disruptions related and unrelated to war in Ukraine are going to keep commodity prices high. A reopening of China, which many of you guys are asking about, could lead to increased demand for commodities. Also, if we were to go into a stagflationary period, commodities could show resilience. Now let's look at gold. Central banks have been loading up on gold, maybe switching from US dollars. We can see for the year 2022, the gold demand has 782 million tons, which is an incredible amount. And I just show the fourth quarter expectations that we have. We haven't seen the end result of that yet. Now, we keep gold as insurance. Remember, we're not speculating on gold. Sometimes You may think because we own gold that we're gold traders. We're not. We're not gold traders. What we're doing is we're using gold and its zero correlation or maybe 10% or very low correlation to equity to protect the downside. The war in Ukraine spurs uncertainty and inflation expectations could rise, making gold attractive. Though expected rate hikes are negative for gold in general, gold protects value in market downturns. Now, the expected rate hikes, well, when interest rates are rising, you can put your money with in a bond that earns a yield, whereas gold will never earn a yield like that. Now, let's review the risk. Inflation quickly gets under control. Central banks' aggressive rate hikes and QT crash the markets. We're underweight equity, so if central banks pivot and stocks go up, we'd also miss the upside. We are mainly exposed to Thai bonds, hence the Bank of Thailand's actions impact the most. And weak Chinese economy could reduce commodities demand, hence lower prices. And other commodities could fall with energy prices too, as it's part of the production costs. Many different risks to our strategies here. But what's the main takeaway? We are now getting close to being ready to answer questions. Central bankers appear to be raising rates into a recession to stifle inflation. Stagflation would be the worst outcome. Demand for necessities like food and energy, inflation, and supply chain disruptions can drive commodities higher. We see opportunities to allocate to specific sectors and markets within equity. Bonds and gold are there to protect capital, not from a speculation perspective. And of course, we do have some risks like global recession and collapsing markets. Now, before we get into the Q&A, we started the Valuation Masterclass Bootcamp number 7 yesterday. The next one starts on March 6th. If you or anyone in your family or friend wants to attend, we are growing and we will keep doubling in size and getting bigger. We have 83 students in this boot camp from 13 different countries, and our limited super early bird price is still available for the March 6th boot camp. And with Phenomena, you can save $100 extra. All you got to do is go to scan this barcode and use the code Phenomena, or go to valuationmasterclass.com bootcamp to learn how to value companies. So until February 23rd, you're going to save $800 on the bootcamp. All right. It is time to ask questions and answer questions. So why don't we do this? I'm going to go right back up to the top of the questions and look for our questions. The first question comes from Ball Conf, I'm going to say. What's your forecast for gold this year? Well, I think that the risk is recession and equity markets fall. And I also think there's a risk that the dollar falls. And that would generally be good for gold. So I don't have a price target, but I would say flat to up. But remember, I'm not speculating in gold. I'm using it to protect the downside. This year, what do you focus on in investment? I would say this year, right, as I've positioned the portfolio, since I'm 25% equity, that's about as low as I will ever go in the all-weather strategy. So you can say my first focus for the year so far has been to have a low allocation to equity, particularly U.S. equity, that I think there's a lot of risk in the U.S. That's my first thing. I would say my other thing is trying to protect the downside. Now, you can say with bonds and with gold, I'm trying to protect the downside. And you can say with commodities, I'm kind of making a bet that if we get stagflation, meaning the economy collapses, but inflation stays high, we're going to perform relatively well with the commodities. And so those are some of the themes that I'm playing. All right. Next question. China will grow up higher than the U.S. What do you think? Well, let's first talk about the economy. The economy of China is continuing to grow over time, and it was expected that it would become larger than the U.S., but I'd suspect that that's down for a while because of the zero COVID policy. The economy has taken a pretty big hit, but eventually it's going to be that the Chinese economy is bigger than the U.S. Also, what's interesting is the Chinese market will eventually be bigger than the U.S. Right now, there's about 3,300 stocks in China that are large and liquid. You can trade them, and there's not that many in the US. So already, from a large and liquid stock perspective, China is already beating US as far as available investments. Now, China has all kinds of problems related to its capital markets, but also we have the zero COVID policy, and we're seeing that they're moving out of that. And I think slowly China's going to come back to life. But I don't expect a huge move in the Chinese market. So let's go into your next one from May. What is your view on China market, both A shares and H shares this year? I would say that it's probably going to be a good year for China, given that it's come out of COVID, and also the fact that it's been such a negative view on the Chinese market with the property destruction and all of that. So I think that this year could be relatively good for China. China is not yet in our FVMR portfolio, particularly in the alpha focus where it would be. So we're not overweight China yet. But I think in the next rebalancing, it may be that China starts to become more significant in our portfolio. So Ballcom says, for long-term investment up to 20 years, do you think gold is still a good idea to diversify risks? Yes, I think it is. But I wouldn't allocate to gold more than maybe 10% of your overall portfolio, because it is not a great long-term investment. It's not bad, but I wouldn't say that you're going to always earn more money in stocks. So don't overweight gold in a portfolio. Now, I'm overweighting gold in portfolios at 25% right now, but that's also because I know I'm monitoring it, and I'll come down on that gold position when equity starts to look better. So if I was you, I would say, yes, gold will be a good diversifier over the long run, but I wouldn't say putting 25%. 25 is probably too high. We're at kind of maximum bullishness for gold and bearishness for equity right now. All right, next one. PPSS Sock said gold is up high level now. What can make gold price down and up from this point onwards? Well, the first thing is, what can make gold prices go down? A strong dollar. If we get a strong dollar, gold price is going to be down. A weak dollar and gold prices are going to be up. It's simple. It's common that it happens in that way. I would also say that I think that the biggest risk over the next couple of years is not in the stock market. It's not in the bond market. It's in the US dollar. And I think it's a very big risk that the US has gone past the point of no return, where they've borrowed so much money that eventually they're going to default. And when that happens, gold price and gold will be a strong store of value. So if you're owning Thai baht as an example, or currencies, other currencies, I think that having a diversification in currencies is one of the biggest risk reducers out there. Nan says, hi, John Andrew, last year is a year of dollar and oil. How about your prediction this year of rabbit? Well, best asset class. REITs could be interesting, I'd say. REITs have been down for a while. So I would say we haven't done any allocation into REITs. And I don't know if REITs is really a separate asset class, because REITs is just owning a lot of listed REITs in the stock market. So I'm a little bit hesitant to call it an asset class, but REITs should be okay. And then if I had to make a choice, I would say probably gold more than bonds. Eventually we'll get a rally in stocks, but I think it's going to be hard. We may get a short-term rally, but for the year, I think it's going to be tough. Dalin Seichia says, hello, John Andrew, what is your thoughts about the Indian stock market in 2023? As of right now, I continue to have an overweight position in the Indian market. And I would say, and that's in the alpha focus strategy. And I would say, let me just look at my Indian portfolio right now. Right now, we have 22% of alpha focus in India. So you can see right now, I'm particularly positive and aggressive in India. Part of that is that India is not as highly correlated with the US market. But overall, right now, it looks good for India. Now, remember, I reconsider and I potentially rebalance every quarter. So I could bring that position down, down to zero on India and switch it into China we don't know yet until we get to that point, our next rebalance. I'm going to ask Alex, who's on the call, when he thinks our next rebalance will be, and then I can mention that just so you'll know. Chayaporn says, have you read Howard Marks's article on sea change? And if you have, what's your opinion on it? Does it have any impact on your strategies? I have not read it. And I have to admit, I don't read a huge amount of strategy. I try to write my own, and I try to do things on my own. When I was an analyst in the stock market covering banks and other companies, I rarely looked at the work of other analysts because I didn't want to be influenced by it. So I have to honestly say I have not read what he's said, so I don't think I can give much feedback on it. All right, Alex has come back and told me that we're going to be publishing our new portfolio weights in early March. So we're still a ways away before that. We're going to hold the positions we have until early March. All right, Nan says, what is on your shelf? Yeah, we got that. All right. And Ayodele says, inflation is basically just printing money, and so more money chasing less goods, basically. Too much money chasing too few goods, right? Rise in the cost of a house is inflation rather than the rise in the cost of gasoline. So again, the rise in the cost of a house is not necessarily inflation. It is just an increase in price, and it's a relative increase in price. And inflation is when we talk about the money supply being inflated or increased, which causes the money to have less value. All right. Supergone said hi. We saw that. Yep. All right. How do you see inflation turn to go as China awakens again, consumes more energy? Yeah, I mean, ultimately, demand for energy as China reopens, demand for commodities should rise. But I think it's probably going to be somewhat of a slow rise in China, but that's my expectation at this point. India seems to be becoming the next global manufacturing. Well, a big beneficiary of what's been happening between the US and China is India. Because, yeah, Vietnam and Thailand are picking up manufacturing that was going to China that's no longer going to go to China. But the truth is that basically India is the only country that has the manpower. You know, China or Thailand, Vietnam are two large countries, Indonesia as far as population is concerned. But India is really the place where they got the most amount. Supergon says, how do you view 60-40 portfolio, meaning 60% equity, 40% bonds, will continue effective as rates and inflation will stay high for longer than in the past? So the 60-40 performance in 2022, well, the bond portion, the 40%, did terrible. Now, we have, in our case, in our portfolios, we have money market, Thai money market bonds. So the damage was much less, but it was probably one of the worst years in history for US bonds in particular, because at the beginning of the year, the Fed started aggressively raising interest rates, and that hurts the value of bonds that you're holding. And so basically, I would say interest rates probably are going to be continuing to come down. And if they do, the value of bonds basically starts to outperform. So if you're holding a bond that's earning, let's say 5%, and the market rate is 5%, and all of a sudden the market rate goes down to 4% and to 3%. So new bonds like yours are being issued at 3%. Your 5% bond is now a pretty valuable asset, and that's going to bid up its price. And so falling interest rates usually means rising bond prices. So to think about it, I would say rates are probably going to fall. Bond prices are probably going to rise a bit in that. All right. Tijani Lawal says, amazing. And I had hated myself if I'd missed this section. All right. Let's continue on and see from your point of view, at this point, we should accumulate gold or not? If yes or no, please describe. I would say, first of all, accumulating gold, the right time to accumulate gold would have been at the beginning of last year, right? Because the market performed poorly last year. So part of our gold allocation was already in the portfolio, just like our commodity positioning was. Loading up on gold at this point is still not a bad idea, because I think it's going to be a weak year for markets. but I don't know if I would own more than maybe 10% of your portfolio in gold, and I wouldn't necessarily go much for more than that. So if I was to answer your question exactly, should we accumulate gold now? I would say there's no problem with that. If you were to take your gold allocation in your portfolio, maybe up to 10%, because I think there are many things that could happen with the US dollar or the US market and the like. So yes, I would say I'm comfortable with accumulating gold, and that would be some of my reasoning. Again, if you want to join the Valuation Masterclass Bootcamp, feel free to click the link that I just showed up there. All right. Anucha says, thanks for insightful view. Preparing for the stagflation, what should be the portion in bond, healthcare stocks, gold? What do you expect the drawdown will be? All right. So if we get stagflation, that means the economy is going down, but inflation remains high. It's important to remember that that is a key time where commodities bring a lot of value to a portfolio. So we're still 25% weighted in commodities. And part of that's probably, you could just say, protection related to stagflation. Being defensive in bonds, being defensive in gold, being defensive in healthcare stocks. I think that there's nothing wrong with that. All of those things ultimately are going to try to prevent the the drawdown. Now you say, what's the expected drawdown? Well, let's try to answer that a little bit more specifically. Drawdown is typically when we're talking about the portfolio. Market fall or fall in price is what we're talking about when we're talking about a single asset. Could the US market fall by 20 or 30% in 2023? I think it's possible. So you could see a drawdown in an all equity portfolio at 20% or 30%. It's possible for 2023. So that would be the concept. Now, for a 60-40 portfolio or for our other portfolios, it wouldn't go down that much. But again, nobody can consistently predict the market, and therefore I like to just hold positions. We move our portfolio a bit to the left, to the right, but we're not getting out of positions and getting into them in an extreme sort of way. So Tijani says, now that the Chinese market is gradually opening after worse previous years, should we be sure things would gradually come normal? I think that China wants to reopen and the Chinese people want to reopen. So I do think that we are going to see a reopening, and what we're going to see is a steady rise in Chinese GDP and spending. I'm not sure how to say that, but is it possible BRICS countries use the yuan backed by gold as a central bank digital currency? From your point of view, what will happen to gold price? Yeah, I think BRICS countries are trying to come up with ideas of how to build a currency outside of the US dollar, whether that's backed with gold, whether that's backed with oil, whether that's backed with some other asset, maybe food, I don't know, but I do expect that they're going to come up with something. You know, the problem is that, you know, you can do gold, but if you look, or let's say you want to do oil backing a currency, the problem is India doesn't have oil. Or if you want to talk about gold, well, not every country has gold, but those are some ideas. Now, that doesn't mean it's going to be a central bank digital currency, the CBCDC. I think that they can create a currency without having it being a central bank digital currency, but they may do it that way. All right, let's look at the next one. May says, when will you rebalance AWAF? We're going to rebalance all of our portfolio strategies. We may or may not rebalance them, but we're going to look at them and publish that at the end of March to give you an exact number, exact understanding of when we're going to do that. What is your view on real estate property prices in the U.S.? I think there's still room to go down with real estate prices in the U.S., maybe another 10 to 30% down for real estate prices in the U.S., because I just think that they're really damaging demand. Ritesh says, how do you select stocks in the Indian market? Well, in our case, we don't select stocks because we're using in India a fund in Thailand in this case, but that has an underlying ETF that owns all the stocks in the Indian market. So in this case, we're not. However, whenever we do stock selection, we always follow the FVMR strategy or format, which I believe, Ritesh, you learned a little bit about tonight in the Valuation Masterclass Bootcamp. All right. Peter Porn says, with the last U.S. election results and the recent speaker choice, How would it impact the future of U.S. politics? I think U.S. politics and U.S. policies are really interesting right now. When the Republicans took control of the House, the truth is Republicans did a terrible job in the election. And part of the reason why it was so hard to get the support for the current speaker is that he did such a bad job in the election, along with all the other Republicans. And so I would say that Republicans have a tiny majority in the House and they have a minority in the Senate. They're not going to be able to do much for the next 2 years. Don't expect much from the Republicans. The only thing that they are going to be able to do aggressively is investigate, because they have the ability now, like Jim Jordan, a ranking Republican on the Intelligence Services Committee, as an example, and other guys in the Republican Party are going to be the head of the committees, and they're going to be investigating the Democrats. And so that's where all the action is going to be over the next couple of years. Do you say the U.S. dollar can crash and the U.S. government may default? Yeah, I think it's very possible. It could be 3 years. It could be 5 years. I don't know. But at some point, America just keeps printing and spending, and eventually the dollar is going to lose value and crash. But it may just be that it won't happen until after, there's other substitutes available. There's just not enough substitutes right now for that to happen. So demand for dollars still remains high. And the U.S. politicians know that, so they keep printing it. All right, how do you view Ukraine war? Will EU market find their way to stay with this condition? Well, the EU market has no say on the war in Ukraine. It's all the U.S. And the U.S. has pretty much announced that it's a proxy war between the U.S. and Russia. So as long as the U.S. says that they're going to stay in this war, Europe is going to be forced to stay in this war. There's nobody in Europe that's going to be able to stand up to the U.S. and say, we don't want this anymore. So this is why I recently published, maybe Alex can grab the link on YouTube. I just today published World War 2.5 is over. And that was the U.S. against Europe. And in that video, I talk about what's happening in Europe. And basically, the Europeans have no control. They're being completely dominated by the U.S. All right. 3D crop. All right. Thanks for the thumbs up. And May says, thank you very much for your answers. You are welcome. And come on. Chat says, do you think that China would increase oil production for exporting immensely to Western countries because it can buy cheaper crude oil from Russia? I think that oil, China is constantly trying to source oil around the world at reasonable prices to bring it back to China. And so, first of all, China, I don't think will be a major exporter of oil. And ultimately, I think that what's happening is that Russia may not be selling oil to Europeans, but they are selling it to China. They are selling it in the Middle East. They are selling it to India. And the fact is that Russian oil is not necessarily coming off the market, which is part of the reason why it's the case that oil price has not been sky high. All right. Alex put a link in here, which you can click on, and you can see that show that I did on YouTube about World War 2.5. And that's where you can find the link. Hopefully you can see it there. Click on the YouTube and you can see it. Well, it is exactly 8 p.m. in beautiful Bangkok, Thailand. And that means it's bedtime for me. Mom's already gone to bed. Curious George is getting sleepy. And same with me. I've been up since 3:30 in the morning when I get up to do yoga and do my morning exercise. And I hope that you are also doing your daily exercises, eating right, watching all that sugar in your diet, and making sure that you're healthy. My job in this case is to focus on making sure that our strategies and our portfolios are strong and healthy long-term, and we can get through the ups and downs. And if I can provide those to Phenomena and give them to Phenomena to provide to you, to the advisors in Phenomena, then I have done my job and we can all sleep well at night. So I want to thank everybody for being on the show tonight. And feel free to continue to ask me questions through Phenomena. Reach out to me in any way. I'll do my best to answer them. And I will see you in a month from now when we'll be looking at what's going on in the world markets. Have a great evening.